Hey, welcome guys to today's webinar, um, understanding stock tables and get that going. Yeah, understanding stock tables, that's going to be the webinar topic today. And we want to do this just for us to understand how to read stock tables, how to understand certain terms that are used in the market. It's not just stock tables, but if you go now to trade online on your apps and all that, you're going to come across all these terms: PE ratio, volume, bid, ask. So it's an important education for an investor to understand what, not just what they are, but how they could be used to make you better at what you do, i.e. investing to make money and all that. So this is a good topic for us to have, and I hope we can follow. And at the end, I'm going to share this so you guys can go back to it and do reference to it. So why is this topic important? Like I said, the terms gonna be used here are terms that are used across the board, not just on stock tables in newspapers, but stock tables on your fintech apps and all that. So you have to understand what volume means, what bid means, and how it relates to what you're doing. We're going to talk about the stock tables, analysis, and the meanings of all those words. Then we'll conclude, and then we'll ask questions. Yeah. All right, guys, let's get to it. This is going to be like a standard stock table that we're going to use. And it's just, I just did this from lots of tables, just try to get some of the key indices that you would see when you pull up a stock table or when you log into an app. So the company or the ticker, starting from left to right, and then the high or the low prices. In this case, they're going to have two. It's usually one for the day and one for the year. Then you have the dividend, and then the dividend yield. Then you have the price earnings ratio. You have the volume being traded. And you have the high and the low. And then you have the last price. And of course, you have the change. So all these figures are just illustrative. They're not for any company. There's no company like that. It's just illustrative to give us as it were, an anchor to go off. So I put a little notes under the figures so you can basically look what they mean. For instance, the volume is the total amount of stocks traded during the previous day. So this is the actual terms and then the actual definition of those terms. But we're going to go a bit more to look at what they mean and how you can use it. So the dividend yield here, for instance, just tells you the dividend or the yield is calculated by dividing the annual dividend by the current price of the stock. That's just what it is. That's just the textbook definition. We want to go a bit deeper and say, what does the dividend and dividend yield mean to you as an investor, and how can you use it? So let's start with the company or the ticker. So every company that is quoted is going to have what's called a ticker, or how the company is going to be viewed or traded or tracked across the screen. So when you look at that computer screen, you see those numbers flashing by, and that's the company ticker. For instance, Apple is going to be AAPL, you might have Zuma ZOM. So it's like a licensed number plate per se that identifies that particular stock for you. So most times you don't see the actual company name, is the ticker that you're going to see. So for you as an investor, you need to know your favorite stocks, what are their tickers, and if you want to buy a stock, you want to make sure you get the correct ticker. You could see, for instance, if you are going to say buy Bitcoin, let's use that. There's BTC to USD, there's Bitcoin Cash, there's Bitcoin Market, there's Bitcoin this, Bitcoin that. They're all different. It's going to be almost the same with stocks. You could want to buy integrated chemicals, and there's the IG, and there's a company called IGI or IGC or IGT. You want to make sure that you're buying the ticker that corresponds with the stock that you want to buy, and you make sure you double check that so that you don't online simply buy IGI thinking it's industrial chemicals. Meanwhile, it's IGT, which is industrial growth. So that's just the key for us here. It's not really a lot of background there. Just understand that you must know the ticker that you want to use when you want to buy, right? So the company ticker, just how the share prices are recognized on the exchange, and it's unique to every individual stock, right? Now we have the 52 high and low. In this case, this is the 52 means for the whole year. So 52 week high and low. And what this basically tells us is the highest and the lowest price for that particular stock for that entire year. That's what it means, the terminology, yeah. But what it tells us is gives us an idea of volatility. So if I simply look at this just visually, the highest price a stock has ever gone to is 56. The lowest price a stock has ever gone to is 39. And I can see here on my last price, which is the almost the second to the last in this year. I see the last price. The last price the stock traded was at 56.37. So that tells me instantly like this company is trading today at the highest price it has ever traded. Does it mean anything? Not really. You have to then ask questions. Okay, why has the share price gone up? Is it because of demand for the company itself, or has the whole subsector gone up in price? You want to find out why. Why is Tesla trading at the highest price today than it's been previously? Is it because sales for Tesla has gone up? Is it because sales for auto companies in general have gone up? Is it because there's inflation and the stock price has simply more gone up as a result of nominal increases? You want to find out why. But what this is telling us is this: at this price of 56.37, the stock is trading at the highest price. So if we wanted to trade, we want to pause a bit and say, am I buying at the very, very top of the market, or could I buy this at a lower price? So it makes you ask questions. You're not buying at the low, you're buying at the very, very, very top of the market. So this is where you want to be clear that if you are buying at the top, do you expect the share price to go higher? If you expect the share price to go higher, then by all means go ahead and buy. But if you think it's going to go lower, then be careful, but when you're buying at the top. So that's what high low tells us, the volatility. It's gone up and we're buying at the very top. Compare with other companies in the same subsector, compare with the market as a whole. Has the market also gone up? If it's not, ask questions before you then take an investment decision, right? If it's the reverse, if the stock has fallen, find out why it has fallen. Was there bad news? Is the company lose any key influential guy in the market that was on their staff? You want to know why, because if you find out why the company's price is falling, it gives you a bit more insights into that company, and then you can then take, as it were, an investment decision. So high low tells you what you're doing in terms of price, not value or valuation or fundamentals, just the price. It tells you that right now the market is offering this stock at the highest price it's ever done, and that people are also buying at this highest price. So you want to find out why, and then you can then take a decision from there, right? The next thing that we have is, now we're getting a bit more technical. We're talking about the dividend and the yield. The dividend is just the return that the stock is going to pay you if you own a stock or if you own one unit of that company. So dividends are usually announced by the company. It's not mandatory that the company should pay you a dividend, but they have to be declared and paid out to you. So if the company, using an example, says it's going to pay a dividend of 10 naira per share, that means the dividend is 10 naira. Simple. There's no calculation there. Whatever the company declares and pays, that's the dividend. But for us to make sense of that dividend, we have to convert that dividend into a percentage, or to get the yield. So we want to express that dividend as a function of what we paid for that stock. So we then compare the dividend per share to the share price of one individual stock, because we do this, want to see how much that share price has paid back to us, which is then called the yield. What has the stock price yielded back to us in terms of return, which is that dividend? So in our example, I think the share price would be at, say, 100. So if we divide 10 by 100, then the dividend yield becomes 10%. Now, the dividend yield then allows us to do a comparison with other stocks, or with other stocks in the same subsector, or with even other asset classes, not even the same subsector or market. So for instance, if I had a choice to buy, say, Dangote, or to buy federal government bonds, how would I compare both of them? They're not in the same market. They don't operate the same. They have a different way of announcing results. The way I would do it is to say, hey, what's the dividend yield per stock on Dangote? And what's the dividend yield, or in this case, the coupon yield, if it was a bond, the coupon yield on that bond? What's that going to give to me if I bought a government bond. So I'm comparing the yield from the Dangote stock with the coupon yield from the federal government bond. And I'm looking for, say, a higher return, right? So if the coupon on the bond pays me more, then I should buy the bond and not the Dangote, because I'm buying an asset class that is safer but pays me more, right? You get that? So dividend yield allows you to do the comparison, allows you to say, hey, which stock is paying me more? I compare the yield, not the dividend announced. So I don't compare 20 naira to 5 naira or 10 naira. I compare the 20 naira to 5 naira as expressed by the price to buy those shares, which is then called the dividend yield. That's what I'm doing. I want to compare the dividend yield across sectors or the same sector, subsector, or even across asset classes. So that's the dividend and the yield. That's what they mean, and that's how we can use them, right? So again, I continue here. The dividend used to prompt questions for you, because remember, you're comparing dividend to the price. So has the price gone up? Has the price gone down? Is that what's boosting the yield? Is that what's boosting the yield? Okay, why did the price go up? Why did the price come down? The real intelligence is when you ask the questions, you then get those answers. You can then make a formalized or more information, fact-based decision process in your investing. Yeah. Again, like I said, you're using a dividend yield to compare across asset classes, right? And you're using a dividend yield to ask yourself questions about that particular stock. If the dividend yield is going up as a trend, say over 5 years, you want to find out why. If it's coming down, you want to also find out why. You want to compare also. Then keep in mind that dividend yield is changing as the share price is also changing. So it's a bit more tactical, a bit more short term. It gives you that guide was a bit more tactical for you to understand that and to appreciate that's what is happening. It's a short term indices, but it can allow you to compare across the board and to see what you are doing vis-a-vis other investments out there. Okay. Now let's move to the price earnings. And now we're in the meat of assets or stock price valuation. So the price earnings, which we're going to call the PE ratio going forward, yeah? The PE ratio is simply the price of the stock divided by the earnings per share of the stock. It simply measures how expensive, if I could use that word, the stock price is. Look at it this way. In our example, the PE is 32, right? 32.53. What it's telling us is this: for every 1 naira or $1 we buy the stock off, we are buying 32 times the earnings. So it's like, in quotes, if you can use that word, it might be overpriced by 32 times, because we're using to get $1 of earnings, we're going to pay $32 if you can look at it that way. So the PE is telling you, is comparing your price to the earnings. It's basically saying, hey, if you buy this stock, it's going to take you, say, 32 years at the current rate of earnings to get your money back, or you're buying it at 32 times the earnings. You can look at it in both ways. It's the same reason, yeah? So let's look at a real example. If you look at Tesla's PE is almost 1,000 or something like that. So what it's telling us is that people are paying 1,000 times earnings when they buy Tesla stock at about the $800 or so price that Tesla is quoted for. So when they pay about the $800, they are buying 1,000 times the earnings of Tesla. Why are they paying 1,000 times earnings? Because they believe that Tesla in future is going to generate more profits. So to those investors, they are wanting to buy those stocks today cheaper. So they're basically saying that the $800 is actually a bargain, that in the future, the earnings of Tesla will go up and compensate for them paying for 1,000 right now. Look at it this way. It's like paying for Messi when Messi was 20 years old, right? The PE of Messi could be, say, 100. So you would say, well, if you buy Messi today, you are buying Messi at 100 times its price in the future. But you don't know if Messi is going to be a very, very good footballer or very, very mediocre footballer. You don't know. You're simply saying, based off my projection, based off how I've seen him in training, based off how he can kick the ball, I think he's going to be a very, very good player. If Messi goes on to become the best player in the world, which he has almost become, then that 100 valuation looks very, very cheap, because you bought at 20, you only paid 100 times the earnings when you bought at 20. But what if he turns out to be a normal footballer? Then you just overpaid. So the PE ratio gives you just a snapshot to say, hey, is this stock cheap? Is this stock expensive? You don't compare the price. It's not the price that tells you if the stock price is cheap or expensive. So if I have a stock that is worth 50 naira per share, and the other one is worth 10 naira per share. So one is worth 50, one is worth 10, but the one that has 50 has a PE ratio of 10, and the one that is worth 10 has a PE ratio of 50. Which is more expensive? Is a 10 naira stock with a PE of 50, because with 10 naira, you are buying 50 times the earnings. But with the other way around, with 50 naira, you're only buying 10 times worth of earnings. So you're buying at a discount of 10. In this case, you're buying at a discount of 50. So you want to buy the cheaper PE. That's just what it tells you. It's a subjective score. It makes you to ask questions. We're talking about the PE now. It's not a once it's expensive, once the PE is high, it's bad. No. It makes you ask questions. What's the PE in the sector? If you took the PE in the state technology sector, you would find that they have a very, very high PE because they're a high growth sector, right? If you looked at the PE in mature company, like say a power grade that just has stable, consistent earnings, the PEs are going to be a bit more reduced because there's no growth per se in those companies. So you want to compare like for like. You want to compare, say, Microsoft with somebody else in that sector. You don't want to compare Microsoft's PE with, say, the stock of, say, a trading company that has a different way earnings coming or a different way cash is generated in that company. So you want to compare like for like, and you can only know if it's expensive when you compare to the other companies that are quoted in that particular subsector. So if a bank has a PE of, say, 5, then the other bank should also have a PE of, say, 4 to, say, 6 and all that. You want to compare like for like, and then that generates questions for you. If the PE is higher, why is it higher? The PE is lower, why is it lower? So a higher PE means a higher growing company. So if all companies are growing faster, why is this guy not growing as much as his mates in that whole sector? If the PE is falling, why is this company having a higher PE? So you ask questions, you find those questions out, and that makes you a better investor, correct? Okay. Then the PE ratio, when we take the inverse of the PE ratio, we get what's called the earnings yield. Just like the dividend yield is the earnings yield. So we can also compare earnings yield across the board. We can compare earnings yield for companies. We can compare in the same sector. We can also compare earnings yield for companies outside the subsector or even outside that asset class. So if you just do 1 divided by the PE, you get the earnings yield. That basically tells you what you're going to earn per share of that stock. So good hack to know there, right? Okay, what about volume? This is, I think, one of the most underrated parts of the stock market valuation. Volume just tells you how much is being traded, how much is passing between buyers and sellers on that trading day. Now, trading is also a very, very, very good indicator because from basic economics, we know that the higher the volume being offered, then the lower the price. And the lower the volume being offered, then the higher the price. That's just basic economics, demand and supply. So what that tells us is this: if a particular stock has a high supply, then the share price is going to go down. If a particular stock has low supply, then the share price is going to go down. That's basically what it is. So we're trying to use the volume to determine the volume of stocks that will flow into the market, especially when we compare this to the bid and the ask prices, right? So if we see a lot of volume, or if the stock price is traded with a high volume, that limits the chance that the company or the stock can post very, very wild swings in prices, because volume can basically come in and take up that demand to buy or to demand to sell. Same thing with supply. If the supply is high in the market, that tells that the stock price in future is going to go down, or even on that day it's going to go down because we have much more demand in the market. So volume is really a key indicator. If we can track volume before it comes into the market, we can track the price, or we can determine what the price would be, i.e. we can know the price is going to go up or down. We might not know the exact price, but we can tell the direction that the share price is going. So again, with the volume, we want to do a trend. We want to see what has been the trend for the volume, say in the past week or the past month or the past quarter. Has volume to sell been high? That's a red flag for us. What about volume to buy? Has volume been high? That's a bullish signal for us, which means that if people want to buy, then the trend is that the stock price may go up, just going off the momentum of those investors. But if everyone wants to sell, we want to ask ourselves, why is everyone getting out of that subsector? And then could there be a red flag on our portfolio? So in that case, we might want to just put maybe a sell order or a stop sell order to say, hey, if the price falls below this, go ahead and sell our stock at this price, just so to protect our portfolio from downside risk. So volume is telling us or trying to give us an indication of where the stock price would go, i.e. the trend, not the actual price, but the trend. If we see a trend of volume up, then we see volume up to sell, we think prices are going to go down. If we see an uptick of volume up to buy, then prices are going to go up. So we want to compare that to get that trend or that feeling of where the company is going to buy, looking at the company volume shares being offered. And the volume, like I said, ties in with the daily high and low. The daily high and low, of course, is just the same as the annual high and low, but in this case, it's just for the day. So the daily high and low is telling us how the price traded that day. So of course, in our example, the band is very, very tiny. So 56.56 as compared to 56.37. When you see a tight band like this, that tells you that the volatility for that day was really muted. The price didn't go up and down per se, which means that there was the spread. That's the word. The spread was a bit smaller. That's an indication of a high volume of stocks being traded in high volume. Because what happens in the stock market is this: if the stock price is at 56.37, if I want to buy, I could say I want to buy at 56.38 to get someone to sell to me. Yeah. And once I stay at 56.38, no one offers, I could take my bid higher. I could say, okay, I'm going to buy at 56.90 just to take it higher to make someone to sell to me. But in this market, what we're seeing is that once I put in my bid of 5.37, I get someone to sell to me. So the spread between what I want to buy and what people want to offer to me is very, very narrow. So that tells there's a lot of volume in the market that's able to meet my demand, which means the prices is not able to go up significantly. So you see how it's all tied up. If there's an increase in volume to buy, what will happen is this: investors will start to bid higher to get access to sellers first. So if the share price is 56.37 and I want to buy, I would just say, quote, like maybe say 60, just to make sure I get to fill my order. And that's why the share prices go up. Because if there's less volume in the market, then I have to increase my price to be able to buy. And if I increase my price, then of course the market price goes up, then the last price then hits that last price, i.e. that's the closing price for the day, and it's up because the volume has gone up. Look at the reversal. If I want to sell and the market price is 56.37, what will I do? Well, I'm going to sell at say 56. I'm going to offer a discount so someone's going to buy from me. Because at 5.566, then people can say, oh, it's cheaper than the market, and they come buy from me, right? But if it's a lot of volume, if I offer 5.6, someone can offer 5.5. So you can see volume traded makes the price go down. That's now the reversal of how the volume works with that low and high price. So what you tend to find is that when the spread is very, very low, which means when the volume in the market is a bit high, then prices tend to not move in higher bands than if the price and not the volume was a bit much, and then you had spreads. Let me just rephrase. The spread is the difference between the bid and the ask. So if I want to buy a stock for 1 naira and I'm getting an offer to sell to me for say 1 naira 10, yeah, that means the spread is just 10. But what if I want to buy at 1 and I get no offers, and I go all the way to 5 before I can get an offer, which means the spread is 4. Now, when you have a lower spread, that's an indicator that the market has a lot of volume, because the market is able to supply and keep the price from going up or going down too soon. Either people want to buy or people want to sell, but there's sufficient volume in the market. In the other example, when the spread is like 4, that means there's not a lot of supply in the market. So if I want to buy, I have to bid higher to attract the seller to me. Same thing if I want to sell, I have to bid lower to attract someone to buy from me. So that's also an indicator of, let's say, lower supply in the market, either of buyers or of sellers, which is then affecting the last price, and there's a function of the volume in the market. So you see how volume and the high and low then work together to basically set that last price or the market price that you see. So the market price is a reflective of the volume in the market, and of course the offer and the bid prices in the market, and they all interplay. If the spread is lower, that tells you there's a lot of volume per se. If the spread is higher, that's an indicator that there's not a lot of volume in that marketplace. Yeah, great. Then the percentage change is just that change we've talked about, the last and the offer and the bid price, and how they have changed but expressed as a percentage. So again, it's just like a way of just visually to give it, telling us this is going to be the change, or this is where the market is going to. In many markets, you have to hit at least 5% or so before the share price can change and stand. So this tells us, hey, if we look at the volume traded, and the volume traded every day is increasing, we can simply watch to say the 5% mark and say every day we want to see the volume go up by 5%. If the volume goes up by 5%, that tells you that the stock price is going to be either stay up or it's going to be on a bid, i.e. people want to buy. But once we start to see the volume taper off, then the percentage price would also start to taper off, as it were. So once you see a percentage differential start to fall below, say, that set figure of 5%, that's an indicator that somewhere in the back end of the volume side, there's not enough volume there to buy, or there's too much volume to sell, and that's now affecting the share price, which is then reflective in this per change percentage. So you can use it with the volume to basically, and the 5 to 52 week pricing to basically give you a sense of where the market is going to. If you see what I'm doing, you can't simply pick just one. You can't simply pick just the PE or pick just the dividend yield to basically call a stock to say this stock will go up or going to come down. It's a function of volume. It's a function of the pricing. It's a function of the spread. It's a function of the earnings. If the company is doing very, very well, it will make money, i.e. sales and earnings. That's reflective in the earnings yield. If the earnings yield is going to go up, that talks about the PE as well. So the PE will then look very, very good. It will be elevated because people want to buy it, right? If people want to buy, then it affects the volume, because the volume then drops because people want to buy. If the volume drops, that makes the price to go up. If the price goes up, that attracts more volume to come to the market. If more volume doesn't come to the market and the price is still up, then the share price keeps on going up and up and up to attract sellers to then sell to the market. So the economics just takes place in the market. Earnings drive yields, yields drive demand to buy attract volume into the market. It's also the reversal. If the company makes a loss, what happens? The volume to sell will simply go up. If the volume to sell goes up, the price falls. If the price falls, and the company's share price then starts to go down in price, more or less. So you can see how the earnings is also attached to the sales price and also to the volume. It's all connected in one way or the other. So if you know one, you want to know how earnings, for instance, affect volume and affect pricing. That gives you how the mechanism of the market works and how you can then use that to forecast prices or to forecast investment decisions. So if I want to buy a stock, for instance, I'm looking for a stock that has sufficient volume so I can go in and go out, right? I want a dividend yield that is pretty high, because the dividend yield is high, it attracts buyers, right? I want a PE, if possible, that is lower, because the PE then allows me to buy that stock at a lower earnings compared to the price, right? And I want to buy at the lowest high and low. If I can get all this across the board, I'm good. If I can't, okay, I can work with it, right? So you want to get the best, or to know what is the best way, or what is the best combination. It's going to be a stock that's got a good high volume being traded, a stock with a high dividend yield, a stock with a low P ratio, a stock with a lot of volume, a stock that you're buying at the lowest price per day and per week, and of course a stock that the share price is always going to change out. This is the wish list. If you find this company anywhere, buy it. It's going to be a wish list. mostly what you see is that you want us to project and say which company will have this stuff that I've talked about, which company in future would have a high dividend yield, would have a high earnings yield, will have a low P ratio, and will also be loved by the market, i.e. the volume. If you can get that, then you want to buy that stock really. Yeah. Guys, it's the end of our session. It's sponsored by The Way I See It, which is our podcast, which is usually out every Wednesday. We talk about money, we talk about finance, personal finance, even sometimes we do train the economy and the political economy, right? So follow it on every podcast station that you can find, Apple, TuneIt, Google Podcasts, on everywhere. The Way I See It. Tune in, listen, subscribe, and join us. And just also a call to action. If you like what we're doing, do support us. Subscribe to the podcast or subscribe to the YouTube channel, Kalu Aja. So follow us on Twitter and support also on Patreon, which is going to be where you can fund us, and then we can basically do more of this, as it were. So try to do this with us. This recording would be on YouTube once this is done, and you guys can basically go in there and, as it were, just watch at your own pace and all that. Yeah. So thank you all for joining me today. We'll see you guys next time we do a podcast or a webinar. Take care. Bye.